Welcome to today's session on walk-forward optimization and how to eliminate curve fitting. My name is Malte Kaup and I welcome you to this session. Just before we go into the topic, let's have a quick look at the risk disclaimer. Risk warning: Forex and CFDs are leveraged products and involve a high level of risk and can result in the loss of all your invested capital. Therefore, Forex and CFDs may not be suitable for all investors. You should not risk more than you are prepared to lose. Before deciding to trade, please ensure you understand the risks involved and take into account your level of experience. Seek independent advice if necessary. And again, if you have any questions, just reach out to the very knowledgeable people at Blackwell. Very helpful. They are very helpful and obviously very happy to answer any question you have. Look, let's go straight into the topic, because I think this is one of the topics where you don't hear a lot about in the CFD trading community, but it can really give you a distinct advantage. Again, nothing we discuss today is to be seen as explicit trading advice, but what we try to do in these sessions, right? We try to be very clear and help to build your knowledge up to a point where you really can have an edge in the market and hopefully become a better, more successful, profitable trader. Right. So we have a lot of material to go through, a lot of kind of condensed content. This session will be recorded. So if you have any questions afterwards, don't feel, don't hesitate to reach out to the people from Blackwell, and they will also probably forward questions to me. I have some people in the room who look after the questions. You have any, just use the chat functionality, and they will surely be available to answer all these questions immediately. But for the sake of the group and given the complexity of a topic, I will focus on the facilitation here and get us through the key topics, right? So what's the agenda for today? Again, very exciting content on walk-forward optimization. First of all, we go back not too much to basics, but we will talk a little bit about what you need to do, develop a trading strategy, having walk-forward optimization in mind. We have other sessions where we talk about how to create a trading strategy in detail. Second, we will then mostly talk about what is walk-forward optimization, and I will show you WFO in action, walk forward optimization in action, using the Blackwell MetaTrader platform to show you how this is being done. And in the end, we land on, once you have a really good understanding of what concept is, we land on, partly, but also the promise for today, we land on the message how you can avoid curve fitting, because there's always a risk, when you play around with back testing and automated strategies and all that, that you create this perfect reality in the past that not necessarily has any application or chances of success in the future. So we get through all this great detail, have people available to answer all your questions. So it should be a very, very exciting session for you guys. So let's start with the basics. What is walk-forward optimization? So as I said, let's start talking about what do you need, what are the input factors when you come up with a trading strategy. Well, first of all, you need to have a trading idea. You need to have an idea what gets you into the market, and that can be absolutely anything you can think of. It can be you get up in the morning at 8 o'clock and you flip a coin, and depending on what you see, you go long or short a specific instrument. It can be solar, lunar cycles, or it can be a technical indicator. And Blackwell has provided a number of highly customized indicators to you, which can help you kind of make that decision. But first of all, you need to get into the market, and then you can apply other rules when you start testing your strategy, like randomness, slippage. Kind of you bake in reality in your testing. You can see if your trading strategy works in different market environments, if your trading strategy works in, let's say, with different financial instruments. Gold sometimes behaves differently than Euro USD versus the S&P 500. So you want to make sure that you send out the right strategy to the right instrument, to the right market environment. So that would be all the parameters you bake into your strategy. And then the market data is important. You need to have sound data to do your analysis and to basically evaluate, looking at the past, can you identify any potential patterns that help you for your trading strategy? Because if a market has established certain patterns, odds are that they actually stay the same patterns, at least for a limited amount of time, right? And that's exactly what we're talking about with walk forward optimization. So depending on where you are, you can do that on all time frames, right? You can do it in a monthly and a weekly and trade on that level, but you can all go all the way down to the 5 minute or the 15-minute chart, or even lower if you want to, as markets are built that way. What's happening on the lower time frames is also happening on a higher time frames. And what we've seen a lot from our traders is that they have used back testing, right? Simple back testing as a means to optimize their strategy in one specific scenario in the past, and that has a lot of challenges, because you create something that is what experts call curve fitted, so it fits to this one reality in the past. And that's a little bit like, well, you found the needle in a haystack, but you anticipate that it will be at exactly the same place when you try to look for it in the next haystack. And that is obviously very, very unrealistic expectation, right? So what we do is we look at lots of haystacks and we try to identify patterns, and we try to thereby approximate, what kind of parameters could give us a better chance of success. So that's what walk forward optimization is all about. So that's what I put here on the chart. So when you look in the middle, walk forward optimization, I say, like, well, we still start with back testing the trading strategy. And we are smart about the back testing, and I will show you in MetaTrader what I mean by that. Secondly, then we start to optimize the strategy as we would usually. And there are some clever tips and tricks available and tools available within MetaTrader that can save you a lot of time finding the most robust set of parameters. And please note this word robust. So I'm not trying to find the perfect parameters. I try to find robust parameters, and I will show you exactly what I mean by that. And finally, when we start with walk forward testing periods, where we basically look at the optimized reality of the past and roll that forward to a more recent time frame to see if that yields at least the same performance, or even better, a higher performance. And I show you exactly what I mean by that. So it's a quite iterative process, if you want to simplify it, that enables you to get the best out of a couple of worlds. One would be the back testing and optimization, but also you test it in reality in a different time frame. Because again, if a strategy works perfectly fine in just one time frame, in one specific environment, it does not have to be the same way moving forward, because markets change, right? And instruments change their behavior, and that's also something you need to adapt to. And finally, that should lead to a performance improvement. Just to give you an idea what we are looking for, we're looking at least overall for a 20% performance improvement after the implementation of walk forward optimization. So it's a quite steep performance improvement. And when I say 20%, that is relative to the overall performance. So if your strategy gives you 5%, it does not mean that it suddenly produces 25%, right? So it is at least 20% on top of the 2%. Actually, we're looking for higher results. We're looking actually for anything above 50% ideally. But just to give you an idea what kind of improvement we're trying to achieve with walk forward optimization. So ideally in the testing environment, you get something that is above 50 to 60% better than your old strategy parameters would have performed. And then in the real life situation, we strive to get then at least a 20% lift, which I think is very, very significant, right? Which can mean obviously the difference between being very successful and maybe just successful or not successful. Let's have a look at some terminology that is just important when we talk about walk forward optimization, or WFO. So you will hear me talk a lot about in-sample data, and you will also hear me talk a lot about out-sample data. And what maybe sounds a little bit strange right now, I'm sure at the end of this session will sound very familiar to you. So please note down the following. When I talk about in-sample data, so that's the data set I use to do the backtesting, to do the optimization, right? And that's why I put it as optimization. And then there is an out sample data set, and that's being used to verify the performance of my strategy. So in other words, when you have a trading strategy, right, and you optimize it using the MetaTrader 4 tools provided by Blackwell, and you use all the indicators and all wonderful things that are available, and you come to a set of parameters where you think this was very successful over, let's say, the last 6 to 9 months, but you want to see the same performance, or even better, a performance lift with that optimized set of parameters in the last 3 months, for example. So in a shorter time period, you want to see that. And that's the outsample data. So again, you optimize on a slightly larger data set in the past, and you try then a smaller data set and check if that performance can be validated. And as I said earlier, we don't just want to look, we are not just looking for validation, we're actually looking for performance improvement, right? So we are looking for a lift of at least 50 to 60% in terms of WFO. So just a little bit more theory, and then we go over to the MetaTrader, and I show you how it's actually working. So what I've done here is I've taken a screenshot of in this case, I think it was Euro US dollar, and I just want to give you an idea how that looks like, the WFO, and also add two more terms to my explanation. One, the non-anchored method versus the anchored method of WFO. So what does that mean? As I explained earlier, and we show you exactly how it works on MetaTrader in a moment. When you do your backtesting in a time frame of, let's say, the last 3 months or the last 6 months, let's say that, and then for you optimize in that period, and then you roll forward the testing to then the subsequent month or 1.5 months. That gives you a good understanding on how that optimized set of parameters is working in a very short time frame in a more recent past. And then you can do the same thing again, as you see in this kind of non-anchored mode that I highlighted for you below the chart. We always move forward a little bit at a time. That could be depending on what time frame you're testing this. This could be a month or a couple of weeks, right? You move forward and you test for the same time frame, and when you roll forward to the out of sample, and you want to see a lift in performance, and you always push that forward. That's the non-anchored mode, where you say my starting point in the testing, and it's always being pushed forward. And essentially what I can tell you already is this can also be fully automated in MetaTrader 4. MetaTrader 4 is not per se defined to do that, but it is possible. That is one of the beauties of MetaTrader. There are lots of kind of additional tools out there, and you can add a lot of bolt-ons. I will already show you how you can do walk forward optimization with what is provided within MetaTrader. But again, if you want to have like an automated non-anchored mode analysis over a couple of months and years, that is absolutely possible. There are no limitations to that. You just need to apply the appropriate codes. And on the right hand side, I have the anchored mode for you guys, right? And the anchored mode is nothing else when you start your back testing always at the same point in time. So this blue bar represents the time where we do the historical back testing in that in sample analysis. That's the optimization I was talking about a moment ago. And then look, we roll that forward to a more recent, shorter time frame where we look at the performance difference of these optimized parameters, and we would expect something like at least a 50% performance improvement, and we want to see that consistently. We want to definitely see consistently a positive performance improvement over all out of sample analyses, and the most recent one should have a lift of more than 50. But again, we come back to that in a moment. Let's see if there's any other basics we're going to go through. Oh yes, I have prepared for you a trading strategy as an example, a very simple Fibonacci trading strategy that works in all sorts of markets. It's a simple Fibonacci day strategy where we look at the previous day, high and low or low and high, and draw a Fibonacci. And as you surely know, a Fibonacci is looking for trend continuation. It's always a question, how deep is the pullback until an entry in the direction of a trend is getting triggered. Where's the stop loss, where's the target? I show you that in a second. So very simple strategy with no guarantee of winning money, but I think it does a good job at articulating and highlighting how the walk forward optimization works in a very, very simple strategy. So let's switch over to MetaTrader 4. And here we are. What you can see is maybe a little bit more than you would usually use in your MetaTrader. I'm not sure how you're familiar with MetaTrader 4. Again, if you have any questions, talk to the people at Blackwell. They're very knowledgeable when it comes to MetaTrader. So what you can see here is on the bottom graph, you already see some backtesting that I've done earlier. So I want to make sure I deliver you some interesting results. You can see the chart here on the top. You can see the navigator, which lists all the EAs, the expert advisors, and the indicators. And I also have a small market watch window open for you guys, just to make sure that we have a good overview for markets that are available. Look at what I've done here is in Navigator, I uploaded one expert advisor. It's called the Daybreak Fibo. And let me just maximize the chart a little bit to show you what this Daybreak Fibo does. Let's highlight also the so-called period separators, which are the lines that show you the beginning and the end of the day. And whenever you see kind of two lines so closely next to each other, then it's likely that we had a Sunday, right? Because Sunday is fairly short in trading terms. And just to give you an example, if we assume, let me just draw a box. Where's the box? I think I need to add the box here. Yeah, rectangle. If we assume that this is the day, that's today, and all we know is like the end of the day, we don't know what has happened after. I'm also drawing this vertical red line. We don't know what's happening after this red line. All we know is this day, and we know that look, the day had a high of a day here at this level, and I'm also drawing the low of the day. So that's all we know. We can confidently say this was a bearish day, and in terms of a Fibonacci, we're looking for a continuation on the next day. So that's why we draw the Fibonacci from this high point to this low point. And we just quick change the color of the Fibonacci to make sure that you can all really see it, and we make the line a little bit thicker. Here, let's turn this one to red and make it a bit thicker. So now you should be able to really see all the Fibonacci levels. This is a 1 hour chart. Let's drill in a little bit more and go to the 30-minute level. 15 minutes, sorry, apologies. So again, this is the day that I've marked for you, the high and the low. And that gives me this Fibonacci. And now we're going into the next day. And the question then always is, how deep is the pullback the next day? And I know a lot of people like the 50% Fibonacci pullback to engage into a trend following trade, which would be a short in this case. I know a lot of people also like the 61.8. And just to give you an example of what the levels mean here, if we would have said, look, we enter short at the 50% Fibonacci, and we put a stop at, let's say, 70%, which often many traders do, and we expect this to reach, sorry, I just moved forward. We expect this to reach the previous day low, which would then be down here. So this would be, when you think about it, we have 30 pip risk versus 50 pip profit expectation. Entry short here in the middle at a 50%, stop loss at around 70%, and take profit at the previous day low. So we are getting close to 2 to 1 in terms of profit versus risk expectation, which I think is quite reasonable because you can also sustain a number of losses before this kind of trading strategy turns sour, right? It doesn't work anymore. And you can see the market has reacted in some shape or form, right? It has reacted, not the clean reaction we often like to see, so it has oscillated around the 50%, has then jumped back down to the 38.2, has jumped back up to the 61.8, and then quite violently sold off, came back all the way to the 50. That's what we love to see, you know. Here the 50 held to the pip, and that gave us confidence that we can see some new lower lows on the day, which we got, and then the market turned around and kind of smashed through that whole setup. A couple of good examples here. One, the market likes to react at these Fibonacci levels. Two, don't hold on to your position, right? If you are a day trader and you ever get a move like this move, right, 50 pips to the downside, you're done. You're golden, right? You had a great day. There is no need just to hope, you know, for a continuation of another 500 pips. You just done what you can expect for a day. If you get 50, 60 pips out of a market in a day, you've done very, very well. So there's definitely no reason to try to chase the markets. Look, and that's what we just don't know. I've shown you the example for one day, but do that for 5 days, 10 days, 30 days, 100 days, and you will find some parameters which, on average, should yield you some more robust results. But you just don't know how deep is the pullback. Is it 50? Is it 61.8? Is it maybe shallower? Is it 38.2? Or what is it? You just don't know, right? Where should I put my stop loss? I'm just not sure. I need to test this. You know, I can sit in front of the computer every day and play around with that in live market situation. That will cost you a lot of time. or you can kind of go through that day by day by day, do this kind of analysis. Again, it will require a lot of time and a lot of hard work just to figure out some really basic parameters. So that's where the first step comes in. And as I said, the first step is backtesting. And let's do exactly that. So backtesting is done in this strategy tester, which you can find when you click on View Strategy Tester, or you press Control R, and then a window will open that looks a little bit like this. Alrighty, let me just open that up a little bit more, because now the chart becomes less relevant. Not irrelevant, but definitely less relevant. And let's go back to, let's say, January, just to make sure that we can also complete all the analysis. It's quite data heavy, and I want to make sure that I can get through everything. I've prepared a bit of a bigger analysis, but you can expand this analysis as much as you want. And even if you have a slow computer, you can connect this to all other users that are using MetaTrader, and they lend you a little bit of processing power that enables you to do even the most complex analysis really quickly. So let's look at what we have here. We have Expert Advisor, we have a daybreak Fibo set up, which is actually nothing else than like a coded version of this. It will draw from the previous day based on the high over low, over low over high Fibonacci, which is either bullish or bearish, all right? And then you can tell it which financial instrument you should trade, on which time frame, how precise the whole thing should be, and you can give it all the parameters you want. So let's go through that. So I said, okay, daybreak Fibo, that's fine. That's how I called it. So the next day, we hope the Fibo will be kind of triggered. That's probably a more appropriate way of putting it, not broken. I picked the euro US dollar, but as you can see from this list, you can pick absolutely anything that's being provided by Blackwell to you. But let's keep it on a euro US dollar. Then you have a couple of options here. You can, especially when you're on some big analysis and you just want to have like a quick and dirty result, you maybe only want the open price of a candle that's good enough for you. It also depends, maybe if you do it on a 5-minute chart, that gives you the input that you need to do your analysis. But in our case, let's be really kind of diligent and go through every single tick that's being provided. I can give a specific date here. So I said use date, and I give it 8 months in 2017. If you click, maybe I do that just to kind of help you understand how this works. So I click on visual mode. The more and more you use this, the less, believe me, you will use this visual mode, because it's just less and less relevant. I'm changed then the period from 1 hour to 15 minutes, which is nothing else than a time frame on a chart. And you can say, let's use the current spread, or let's do some other spread. Let's just fix it at 2 pips. I think that's a good average. And let's hit start. So what it does now is it goes back to the Blackwell server, and it gets all the data it can find on the Blackwell server from that time frame. As I said, I told it to start 1st of January 1st of January 2017, and you can see that it already has triggered, because the market that was let's see if I can show you the period separators. See, so this was like where we have this wide vertical line. This is where the market has started. And the market pulled back right to the 50. And I will show you in a second how I done it. But it's been set to trigger at the 50%. And it went short. The market actually is performing quite nicely. And we had a full lot. Actually, no, it actually, the way I said it is, it had already sold limit ahead of a 50. We can look at the settings in a moment, and it's actually tracking in a good way, right? So that's how this is working, and you can. That's the beauty of what the beauty is of technology, is you can just accelerate the thing and just do it really really quickly. right? So when I move this up to full speed, you can see this thing is going through every single day, and it's looking at the previous day Fibonacci, and it's getting triggered, shorts, longs, good knows what. It's getting triggered. I have no idea how good the performance is because I haven't really played around with the parameters. But this is what the strategy tester does for you. It saves you a lot of time because this is now going through the whole year. So look, we are already at the end of a month, and it will just continue for the next couple of months. For me personally, it's quite important that I can see in the strategy tester that it's doing the right thing. It's doing what it's supposed to do. But once I have confidence in that, I can click away from visual mode and just click on start, and it will do the same thing just without showing me every single entry and exit. And it will just go through the trades one after another. You see, we have, what is it, 350 trades, and the performance is actually quite all right in that time frame. It has gone up. We have had a few setbacks. The first 24 trades looking not very promising, but then it has picked up afterwards. All right, and I'm cheating a little bit because I've done the analysis before, so I have a bit of a feeling for when this is supposed to be a more promising set of parameters versus a less promising set of parameters. Again, this is educational, and that's why I'm showing you. I'm also want to show you how I get to this conclusion, right? So here on expert properties, that's where we have the settings. And the settings, just to be very clear, again, no trading recommendation. This has already triggered the entry at 40% Fibonacci retracement, stop loss at 50, and take profit at 150. So very tight, when you look at the percentages, very, very tight money management. But when it wins big, right? So you expect to be stopped out quite a lot. But when you're lucky enough and one of your trades runs into target, then you're really being rewarded, and I think that's what this shows, right? So always bigger steps up. So these are kind of trades where in this case probably where we got like the full extent of the trade, where you see kind of a smaller moves up. But this trading strategy, obviously, as it only allows one trade a day, it will close the other trade before it opens another one. That's why you see kind of smaller moves in a certain direction. But that's all fine. That's part of the strategy. But what we don't like what we see here in the beginning. But nevertheless, I think I already found the needle in the haystack. Just to give you an idea on how I arrived at this analysis, I clicked the little tick boxes here on the left for entry, Fibonacci retracement, stop loss, and take profit, because that one immediately voids the column here on the left value, and it activates the three columns on the right, being start, step, and stop. That's really important, right? So start means like I test starting entry Fibonacci level 40 with a step of 10 all the way up to 80. So that means nothing else. 40, 50, 60, 70, and 80 are my entry levels. Stop loss, I start at 50, right? And with a step of 10, I go up to 70. So that's 50, 60, 70, three combinations. And take profit, I'm playing around with a fairly wild field, starting at 50 in steps of 20 all the way up to 160, right? So I was not expecting that my really narrow money management would yield me any positive results. But given that Fibonacci is basically also nothing else than another way of following a trend, right? I didn't expect kind of a very tight money management rules to yield me any positive results. So, and you can then start this analysis. I need to click on optimization, so I forgot that. I can now start this analysis, and I will not bore you with it because that takes a little bit of calculation power. I've done it before, but I'm not sure if it does it by brute force again. See, a fairly fast machine, but it would still take at least 7 minutes, and this counter will probably go up. But it's already testing all sorts of combinations in my analysis, right? So it has now already had one pass where it used like entry 50, stop 50, take 50. This can't give me any positive result. So that's why the profit is zero. And now it goes through all different combinations, right? And that's the optimization. That's the first part of the walk forward optimization. That gives me a view of how many trades a specific setup generates, and how big is the drawdown, and you can all have all sorts of ratios that you want to use to analyze your trading strategy. How big is the profit? But it's so tight, and where kind of the entry and the stop level are on the same level, you don't expect any profit. That is not a surprise. What's quite powerful is that you can show then the results in a graphical way, right? And it's now building it slowly up. It's texting all these combinations of like an entry level, and also a take profit level and a stop loss level. So we have an entry level here 40, 50, 60, 70, 80 in the Fibonacci, and we have a take profit level of 50 to 180. And you can see that already, like it looks like the 70 the 70 here take with an entry of 40 and a stop at 60 was actually quite positive. I'm quite stunned to see that, right? And it's now building all that up. And basically, what's happening is the darker green the colors are, the more positive the result was. And I have done this analysis before, and let me show you a screenshot. So I've shown you a screen. I'm showing you the screenshot now, and it's pretty small. So let me articulate what you see. You see the dark green box here on the bottom, which highlights the best performance that we've seen, and the white boxes haven't given any performance or have lost money, and also kind of the light green doesn't show like a very strong performance. And that was the combination I had between 50 and 150. So 50 for the entry and 150 for the take profit. Let's go back to MetaTrader. Where is it? Yep. Here we go. Oh wow, it's doing really well. It's already done kind of half of the analysis that I've just shown you, but we can stop it, and we can then change this to what did you say? 50, 60, 150. 50 entry, 60 the stop loss, and 150. So let's see what kind of result we get for that. If not, I change it back to 40 if that gives us a decent result. So it went through the analysis. Oh, I should have unclicked optimization. I was a little bit too fast. So again, we're looking at every single tick in euro US dollar on a 15-minute chart, and we are looking at the analysis. So that has not shown us a really great result. So let's change it back to what I've shown you before. 40, 50. So 40 for the entry, 50 for the stop loss. So let's see. That was really, I think, a great example of backtesting. You've seen kind of the one combination that I've shown you, and the equity curve whoop, shot down in the seller, right? And another combination, and suddenly we're making a good return. And that's the needle in the haystack. And it's really, really hard then to understand if that needle really stacks up in a way that that combination can deliver you consistent results moving forward. So what you do is, and again here in the webinar, I have to simplify just a little bit, but I think we're getting, you're probably getting the gist, and we are very clear and very technical. So what you do now is, so I have a time frame from January to August, right? So that's 8 months. And we have yielded something like 20, what's that, 25%, which I think is a solid number, but it's also 8 months, right? It has taken a while. So now we're rolling this forward to a shorter time frame. So I'm starting in July and run it until pretty much the end of August and see what kind of result I get for that time frame. So that's what I really like to see, right? So now I have, for the last 2 months, I have a performance of, it's not even 2 months, it's 1.5 months, right? So I have a performance of close to, let's say, 18% or something like that, right? Um, which I think is really cool when you compare what I've shown you before. That was over 8 months, 25%, and for just a few percent less, we're not only for 2 months in the market, right? And that's a really good starting point in terms of walk forward optimization. And you can do that now. That's exactly, so now I'm testing exactly what I said earlier. Now I'm testing out of a sample. So we have tested kind of a previous time frame. Probably if I want to be perfect, you probably want to go back to July 2017 and then go back like 9 months. And then you roll it forward for a couple of months and you see if you can deliver the same result. Because if you just do what I've done now and you do it over and over again, you kind of fiddle around in the same data sample, and your performance will just be perfectly curve fitted for this one scenario, right? So what I'm saying is, you probably want to go back in your analysis a little bit further, let's say October 2016, and you ended in June 2017, and you let the analysis run. And just for the fun, let me just do it. I don't know what the result will be. And whatever the combination here is that you like, that you think is powerful, you take that then and roll it forward to, in my example, the last 2 months, like 1st of July until the end of August. That's for your out of sample analysis. And that gives you then reason to believe, if you see a nice lift in the performance with that optimized result from the past, that gives you reason to believe that your walk forward optimization is working for you. Look, so this analysis is not too bad. So if you just kind of um, reset the thinking and say, like, all right, so I found a set of parameters which at least gives me, what is that, 10% over the last what is that? It's not even a year. It's like October, December 2016 plus 6 months. So that is 8 months. If you split in years, that is 6 months in 2017 and 2 months in 2016. And now I roll it forward. I go into the out of sample. So that's July and August 2017. And I run the analysis over that time frame. Sorry, I need to move that forward. And the graph is picking up, just for 2 months. We have, what do we have? 17% or something. So that's the performance lift that we're looking for, right? That's exactly the kind of lift we're looking for. And you need to make sure that this differential is at least 50% between the in-sample testing versus the out-of-sample testing to give you reason to believe that you're going in the right direction. And you can do that as I showed you. And let's now go back to the PowerPoint. I can show you how that now kind of works in this iterative way I was talking about earlier, right? So you have this non-anchored mode, and you do your out-of-sample analysis, in-sample analysis, and then your out-of-sample analysis, and you push it forward, you push it forward, you push it forward, and that just gives you, the more you do that, gives you a more robust answer. What is the most appropriate set of parameters for you to use in the current market environment? Understanding that market is changing all the time, right? So that's I think that's a really good example. And the second one here is the anchored mode, where you just don't change the start date. In our example, what I did is I started testing October 2016 and ran that to June 2017, and then ran it forward to July and August 2018. And basically what you do is you just, as time goes by, you just extend that period that you use for your optimization, and you always add the same couple of days, weeks, or months, whatever your time frame is, right? To do the roll forward testing or walk forward optimization. So that walk forward optimization can give you a real edge, right? And we're looking to improve the actual performance of a strategy in the near term, or in region of 20% to make this exercise worthwhile. So let me just bring everything together, because I think we've gone through a lot of information, and good that we recorded this webinar or this session, and you can have a look and rewind. And if you have any questions, please do reach out, because I think it is a bit more complicated than most of the topics that are out there. Just to summarize how to avoid the curve fitting piece. So you're looking for robustness in your walk forward ratio or walk forward efficiency. That's also what a lot of people call that. So you look at basically, if you want to do it perfectly fine, you look at your annualized gain of the test period in this out of sample to the annualized gain of the optimization period in sample, right? And you want to make sure that you get a lift of 50 or 60% to make sure that you haven't just over optimized your strategy in a way where basically the optimization in out of sample basically equals or correlates with the optimization in sample. Because if that's the case, you basically have done nothing else or just fitted yourself perfectly to history, and that's defeats the whole purpose of walk forward optimization, right? The whole point is another one. The point is that you try to derive from recent history, you try to derive some evidence that we are in a market environment where the set of parameters has a chance of survival, a chance of being successful for you. And again, it depends on your time frame, right? If you're on a weekly, these are all happening on a weekly basis. If you're on a 5-minute chart, this can all happen within a couple of days, right? So that's the beauty, and you can always you can automate that basically, and continuously optimize your strategy, and taking a lot of the hard work and the guesswork, quite frankly, out of trading, and put a lot of sound, robust analysis in there. You also want to make sure that more than 50% of all your walk forward optimization tests are actually profitable, right? This regardless of the anchored or the non-anchored method. That's really important. Just make sure that again, you're not just chasing that one needle that you found. It's about robustness, and the robustness means that you have found a number of parameters that work really well. You want to have an even equity distribution, or in other words, you don't want to have any massive drawdown scenarios, right? Imagine, put yourself into the shoes of somebody who has let's say a 1 million euro account and loses 40%. How would you feel if you just lost 400,000 euros, right? Would you be hitting the market still hard? Probably not. You probably would change your behavior, and that's something we don't want to get into at all. That's why we really don't want to see drawdowns of more than 40%. Ideally, we don't really want to get below 20%, 25%, because then kind of psychology kicks in, and it's really hard for traders then to get back on track, basically. All right, let me just summarize what we've discussed today. So walk forward optimization, how to eliminate curve fitting. We defined what walk forward optimization actually is. You do your strategy development, you do your back testing, your optimization, and then you go into kind of the more recent past, or you can also do that on demo if you want live in real time, right? You basically with testing the future with the parameters that you've identified. That's also possible. We've talked about the anchored versus the non-anchored method in walk forward optimization. I've given you a very specific example without giving you trading advice using this Fibonacci strategy, and showed you how you actually can do that with MetaTrader, testing and optimizing in one time frame and then rolling forward into the next time frame. And then I gave you some very explicit guidance on how to avoid curve fitting, right? How to avoid curve fitting by making sure this walking forward efficiency ratio is greater than 50%, by making sure all your out of sample tests are positive, and that you don't incur a drawdown of more than 40%. It's all being recorded today, and if any question hasn't been answered by the colleagues from Blackwell, please feel free to just shoot them an email. We're very happy to help. It was quite a dense topic. We have a couple of other complicated topics available as well, so hopefully that something you found interesting, because I think I have not seen that anywhere with any broker out there. So hopefully you get a sense that Blackwell is equipping you with the right tools and the education that helps you really advance your trading. If there's anything, guys, you are interested in, please feel free also to shoot them an email at Blackwell, or just call them. I'm sure we can add that to the curriculum moving forward. All right, thank you very much. This was Malte Kaup, and yeah, I wish you continued luck and success in your trading. Thank you very much. Bye bye.